AP, New York, Friday's afternoon trading on Wall Street saw a decline in stocks as key indices finished the year poorly amid continuing worries about stubbornly high inflation and a looming recession. As of 12:01 p.m. Eastern, the S&P 500 decreased 0.7%. Investors view the index as a benchmark for the entire market, and it is projected to lose 20% by the end of 2022. Its worst loss since the financial crisis 14 years ago would be that. The Nasdaq composite decreased by 0.7% and now projects a far more significant annual loss of 33.5%. The index is performing significantly worse this year as a result of its high proportion of technology equities, which have been driving the overall market downturn. On the final trading day of the year, Wall Street had little business or economic news to evaluate. Tesla has leveled off after suffering heavy losses earlier in the week, but it still stands to lose 65% of its value this year. Following significant disruptions throughout the holiday season, Southwest Airlines operations returned to a state of relative normalcy, stabilizing the airline. The market as a whole fared better in the energy sector as U.S. crude oil prices increased by 0.6%. Rising bond yields. Mortgage rates are influenced by the yield on the 10-year Treasury, which increased to 3.89% from 3.82%. At the start of 2022, the key lending rate of the Fed was in the range of 0% to 0.25%. Following 7 rises, it will end the year in the range of 4.25% to 4.5%. By the end of 2023, the range is expected to be between 5% and 5.25%, according to the U.S. Central Bank. No rate reduction is anticipated in its prediction before 2024. Early in the year, the Russian invasion of Ukraine exacerbated already existing supply chain problems, increasing the volatility of the pricing of food, fuel, and other commodities. China spent the most of the year implementing draconian COVID-19 laws that hampered the manufacture of commodities and raw materials, but it is currently working to lift these and other restrictions on travel. The first week of 2023 is expected to bring about a number of significant changes to the labor sector. It has been an especially robust sector of the economy and has contributed to building a wall against a downturn. However, because of the robust employment and wage growth, the Fed may need to continue being aggressive in its fight against inflation, which has made its work more challenging. This in turn increases the chance of overly slowing the economy and starting a recession. On Wednesday, the Fed will disclose the minutes from its most recent policy meeting, perhaps providing investors with more information about its upcoming actions. The most recent wave of corporate earnings reports, which will begin to arrive around the middle of January, are also on Wall Street's radar. Companies have been alerting investors that inflation is likely to have a negative impact on their revenues and profitability in 2023. After boosting prices for everything from food to clothing for the most of 2022 in an effort to counteract inflation, several businesses went farther and actually improved their profit margins. According to FactSet, businesses in the S&P 500 are anticipated to generally record a 3.5% decline in earnings for the fourth quarter. After that, analysts anticipate earnings to largely hold steady through the first half of 2023.